Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachordes, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, let's begin over in the U.S., where we'll get the all-important jobs report on Friday. All the signs are that the jobs recovery is gathering steam. So what are the forecasts for March, and what reaction can we expect to see in markets if we get a strong report?
So, well, Maria, we did see that worrying slowdown in the labor market at the end of 2020. We did see a decent rebound in February, but we are expecting an even bigger rebound for March. So consensus forecasts are for an increase of 500,000 in non-farm payrolls, and that would potentially push the jobless rate down to 6.1%. And as far as the market reaction is concerned, it's a little bit hard to predict these days, given which way treasury yields would go, and of course which way risk appetite would be swayed by. So at the moment, it is looking a bit like a win-win situation for the US dollar, because we are seeing downgraded forecasts for other economies, whereas the US economy seems to be powering ahead with its recovery. So even if we were to see a disappointing jobs report, it's unlikely to dent that picture that the US economy will outperform. So a disappointing jobs report could generate some safe haven flows, and that in turn could help the US dollar gain even on a NFP miss. On the other hand, a strong jobs report would almost certainly boost the dollar, especially as it would lift treasury yields. So the only thing that could potentially damage the dollar is if we were to get a very, very bad jobs report, which is pretty unlikely as things stand.
Okay, over the past week, the Australian dollar has taken a beating against the greenback. Regarding next week, there will be a flurry of domestic data out on Thursday, but there might be a bigger reaction in the Aussie to Chinese manufacturing gauges. What should we expect there?
So it's going to be interesting to see what's going to happen to the Chinese manufacturing PMIs, because they have actually been edging lower in recent months, even though manufacturing PMIs from other countries have actually been rising. So if we were to see another poor month, that could raise some concerns about China's recovery, although the forecasts are that we will see Chinese PMIs improve in March, and that in turn could help the Australian dollar. So the Aussie has taken quite a battering because of we have quite a bit of risk off in the markets, mainly on the back of those fears about the European recovery after we had those announcements of fresh lockdowns. So overall, the Aussie will be tracking the global risk sentiment, and we shouldn't see too much of a reaction from the domestic data out of Australia.
Turning to Europe now, we'll get the economic sentiment indicator on Tuesday and the flash inflation print on Wednesday. In the UK, the second estimate of fourth quarter GDP is due out on Wednesday. Is any of this data likely to matter for the euro and the pound?
Well, that's pretty unlikely. So the focus will probably remain on the vaccine drama. So EU leaders have now agreed to restrict exports, or at least tighten controls, tighten the criteria as to exporting vaccines out of the EU. Now that could potentially hit UK supplies, but investors for now remain pretty optimistic about the UK's vaccine rollout, but they are pretty downbeat about the EU's vaccination program. And of course, on the back of those lockdown announcements we had out of Europe over the past couple of weeks, the euro has been sliding quite significantly against the US dollar, and we could see a continuation of those trends in the coming week. The pound has managed to turn around a little bit against the US dollar, as even though the third wave in Europe could potentially hurt the UK as well, but investors are trying to stay optimistic. But as far as the euro is concerned, the risks clearly are still to the downside.
And finally, on April 1st, OPEC and its non-OPEC allies will be holding their monthly output meeting. What action do you think the major producers are likely to take this time? And how might oil prices be affected?
So, given all the gloom we've got coming out of Europe, it's unlikely the OPEC Plus alliance will want to risk raising output just yet. It's been a rather poor month for oil prices. We've had quite a sharp drop, and so the major producers will probably decide to roll over the current production cuts to April. But this is pretty much expected. So at best, they should support prices. In order for oil prices to move higher, we would probably want to see some hints that the current output curves will probably last for quite a few more months, as opposed to maybe just the next month or two.
Rafi, thanks so much. And thanks for joining us at XM.com.